Yo, what's up traders? So in this video, I'm going to talk about risk to reward and how technically you could be wrong or 80% of the time or right only 20% of the time and still be profitable. So I get a lot of questions about this, and it's definitely, you need to understand the basics of risk management, risk to reward, and how you can incorporate numbers into your own training. So this may be a shocker to you, maybe or maybe not, but I am not a numbers guy at all. And in fact, you don't have to be in order to trade. So I'll repeat that. You do not have to be a math genius in order to know how to trade currencies, trade oil, trade gold, trade stocks, whatever it is that you want to trade. So, but these basic principles you do need to know, and so in theory these work. There's a lot of other variables going on, like volatility in the market. So if we're talking about 100 pip moves here, lately 100 pip moves really haven't been happening, but for the sake of this demonstration, I am gonna we'll use that as a baseline. If you have any questions, message me, and I teach this in more in depth in my group, and we're trading every day together in the markets in my training academy. So with what I led, if you are only profitable 20% of the time, like in this top column is the percentage, your win percentage, and this column is 1-to-1. So what does that mean? That means if you have a 1-to-1 risk to reward ratio, in other words, if you had a trade and you put 100 pip stop loss on it and 100 pip take profit, so you're risking the same amount that you may lose to what you would gain in a single trade, right? So that means it's an even risk to reward, and we don't want an even risk to reward. Why do we not want that? Because the market already has an edge on us, right? So that's why blackjack casinos, Las Vegas does not care how many times you sit at a blackjack table. In fact, the longer you sit there, the better, because it knows after an extended period of time, it's by far has the edge on you, right? So if you get lucky the first few hands and hit, you should probably leave, right? So, but if you have a 1-to-1 risk to reward ratio, then you have to win at least 50% of the time, and that is it's very hard to do. So that would mean this X right here, if you only won 20% of your trades with a 1-to-1 risk to reward ratio, then you would not be profitable. So if you had a 2-to-1 risk to reward ratio, that would mean you had a 50 pip stop on your trade and 100 pip take profit. You still would not be profitable if you only won 20% of the time. So that would mean you would have to win at least 3 times in order to be profitable for a trade. So typically that isn't the best. This is where we want to be, 3-to-1, and this is kind of how I roll in this area. 3-to-1 risk to reward. So if you have 100 pip stop loss, that would mean or 100 pip take profit, that would mean your stop would be 33.35 pips. Okay, so but if you only won 20% of your trades, you would not be profitable still. So if you're only winning 20%, and you could still do that. There's many funds out there, traders who this is their win ratio, but when they do win, they're winning 5 times the amount of they're risking. And in fact, that's what you have to do. So 4-to-1, which would be a 25 pip stop, 100 pip take profit, you would only be break even. But if you have a 5-to-1 risk to reward ratio, then you would in fact be profitable. So that would be a 20 pip stop loss and 100 pip take profit target. So moving on, 30%. I know this is a bunch of numbers, but really, and you can go to my post, and this is where this is coming from, a post I did yesterday, and I got a lot of questions on it, so this is why I wanted to do this video. 30% win rate at 1-to-1 risk to reward, still not profitable. So this is why the 1-to-1 you want to stay away from. 2 to 1, 50% or 50 pip stop, 100 pip take profit, still not profitable. 3 to 1 at a 30% win rate, so that would be 33.3 pip stop loss, 100 pip take profit. You would barely be profitable, but you would be profitable, and just a little bit of profit is profit. 4 to 1, you would be profitable, and then 5 to 1. This is the sweet spot right here for sure. 5 to 1 risk to reward, you would be profitable. 40%, 1 to 1, still not profitable. 2 to 1, however, you would be profitable. So if you can get to where you have a 40% win rate, that is incredible. That you are really dialed in on the market, you're in the zone, and that is a magical place to be for sure. And I can definitely help you get there in over an extended period of time. 40%, 2 to 1, you're profitable. 3 to 1, profitable. 4 to 1, profitable. 5 to 1, profitable. So the thing is, as we go up with our profitability, plus we have a larger risk to reward ratio, then this makes our risk to reward more of an exponential growth like that. So this is, if you're winning 40% of your trades with a 5 to 1 risk to reward ratio, that is very good. 50%. If you're 1 to 1, that would mean you're at exactly break even. 2 to 1 profitable, 3 to 1 profitable, 4 to 1 profitable, 5 to 1 profitable. So you could see if you're winning half the time, plus you're hitting 100 pips at a time for half of those trades, that's a huge percentage. The problem with that is right now, at least using a 100 pip take profit in a low volatility environment, we're just now starting to see moves equaling up to 100 pips. So right now it's pretty much in the gold market, silver, oil, indices, but not as much with Forex right now. But that is definitely picking up. We saw some monster move in the yen, USD yen yesterday. So volatility is coming back for sure. Now 60% is epic win percentage, and I can get up here on my good weeks for sure. But this is really being plugged in, really dialed in, and then you're hitting all of these categories, profitable in all of them. Right, but still, you don't want to do 60% with a 1 to 1 risk to reward ratio still. So this is pretty much you don't want to do, and you definitely do not want to have a negative risk to reward ratio. But still, when you're doing this, it is so important. I know a lot of people that are watching this that are my students probably know what I'm going to say. You want to safeguard your account anyways, right? So this is one of the first things I teach, and whenever somebody comes into the group, no matter what, and this is what I really try to indoctrinate people with my signals, is stop loss at break even. Now, this isn't like some secret strategy or not. A lot of people do this, and you should definitely be doing it too. Get into the habit of moving your stop loss to entry so you can protect the capital in your account. So we don't want to be defensive traders. We want to be always on the offense. We want to be making moves in the market. At the same time, we need to protect ourselves. And so this becomes a habit. It sounds easy on the surface, but becoming to where it's second nature, where you're always thinking moving stop loss to entry, which that means if your trade's in profit and you move your stop loss to where you entered the market at, if it goes back down and hits your stop loss, you are taken out of the market without any loss. And so, going back and leaving without any loss is a good place to be, because there is always 101 million% another trade out there for you to take. So remember that, you know, no FOMO, no fear of missing out, because there is always going to be another opportunity in the market. And it's really our mindset that creates those opportunities. And I will definitely do another video about that later. So I hope this was a quick, brief introduction to risk to reward, the way you want to use it, the way you want to start managing your positions. You know, when you're risking, when it comes to what risk size you should use, especially as a beginner, 1 to 2%. 1%. And I know a lot of people that follow me are new traders, beginners. For the love of God, trade on a demo account. I'm telling you, man, trade on a demo until you're 6 months in. So, you know, the way I teach people, the way I approach people in my program is a 90-day program to being consistent, to being profitable. And the way I give that to people, the way I expect people to take it. They don't always do, but through that 90 days, if you go through the program within 90 days and follow the way it's laid out, by the end of that 90 days, I promise you, you will approach the market. You will not be afraid. You won't be blowing accounts, and you will actually be confident that you can wake up, you can pull out your phone, and you can make profits in the market. You're not going to be scared. You're not going to be scared to enter trades. You're not going to go into like my chat room. It's pretty advanced. There's a lot of good traders in there, all levels. It's super inviting, but you can go in there and you can participate in the chat. You can share your charts. I'm in there talking, and you know what it is I'm actually talking about because you went through the program as it's laid out, step by step by step. And if you do that, you'll understand risk to reward, stop loss at break even. And by the end of that, if you'd been trading in a demo, you'd be ready to go live and to be profitable in the market. So I hope this video, you found it exciting, made sense, and you know, it's just a brief summary, but I hope it's a good introduction to what it is that I have to offer and how you can definitely start to look at the trades in the market in a point of view of risk to reward. So that being said, thanks for watching. I appreciate you. If you'd like to get involved with our group, we would love to have you. So click the links below to get started, and I'll see you in there. Peace.